Okay, peeps, welcome back. So today we're going to be talking about 3 strategies to hedge and profit during a market downturn. So with that being said, let's get it. Okay, so as you guys know, we talked about the SOM rule previously. The one thing I want to say about the SOM rule is there is, in a lot of cases, that does indicate a recession coming up, but not every single instance indicates a recession. On top of that, the results in terms of how the markets react to the SOM rule is kind of a mixed bag. I went back in history and looked at some of this myself, and in very few instances did the market actually have a huge drop. And when I say huge, I mean like 30+% drop to the downside. Okay, in very, very few instances did that happen. There was some that it went down when it was triggered, when the SOM rule was triggered. There was some instances where it was already in a downtrend when it happened, and there was some instances where it actually went up or marked the bottom as it was triggered. So it's hard to say exactly what the markets are going to do. So anyways, let's go ahead and get into the content here. So the first strategy that I want to talk about is one that we have actually never talked about on this channel before, and that is TMF and TLT. Okay, so I'm going to show you guys this. All right, so basically, in short, what TMF and TLT is. Let's see, what chart is this? This is TLT. So I actually want to start with TMF. So this is basically 20-year treasury bills with, I suppose, like 3x leverage or something like that. So this pretty much is an inverse. It's an inverse position that you can buy, which pretty much inverses the Fed's move. So if the Fed raises rates, then theoretically the price of TMF would go down, and if the Fed cuts rates, the price of TMF would go up, as you guys can see right here. If you're following me from the left chart to the right chart, you can see TMF is going up. This was back during the pandemic, and so TMF was going up, and as the Fed cut rates, this thing went parabolic and went to the upside. So first thing I want you guys to understand is how exactly this works. So bond yields. Okay, you guys got to understand how bonds work first. Generally, when the Fed funds rate is at lower levels, the yields for bonds are low and the price for bonds are high. Okay. And why is this? Because money flows out of bonds when the Fed funds rate is an all-time low. Okay, so when the Fed funds rate is at an all-time low, basically savings interest rates, certificates of deposits, and bond yields pay essentially nothing. Okay, and inflation is 2%. So if your savings and your bond yields are paying nothing and inflation is at 2%, people that want to make money are going to do what? They're going to move their money into risk on assets like stocks, crypto, stuff like that, things that are going up in value. On the flip side, I suppose, like, for people that are looking for yield, okay, the people that want to make money on their money, so to speak, without having to trade, because that's essentially what this would be. If they're looking for the bond yields, they'll get out of that and go to something like dividend paying stocks or something else, covered calls or whatever. But for people that want to get into this knowing that the price of the shares is going to go up, they want to buy into this as the Fed's cutting rates. Okay. So when the Fed funds rate is at an all-time high, that's when the yields for bonds are at all-time highs and the price is at all-time lows. So, and again, why is that? Because if there's a recession and the stock market drops 10, 20, 30%, these people don't want to lose their money. They don't want to get dumped out by the market. So some of these people would rather just, especially people with a lot of money, would rather just put a lot of their money on the sidelines and something that has a safe, pretty much backed, guaranteed by the government 5% yield versus risking a 50, 20, 30, 40, 50% drop in stocks. So now that you guys understand how the bond yield price inverse correlation works, now we can get into TMF and the Fed funds rate. So TMF is basically pretty much the bond version or ETF version of bonds. Okay. So the thing I want to point out here is if we go back in time, and again, this is not it doesn't have a lot of history here. TLT actually has more history, but you guys can see that basically when the Fed started raising rates, what happened here? Basically, I mean, it's not exact, but pretty much the TMF was at all-time highs, and then the Fed raised rates, and what did TMF do? It went down. Okay. And then the Fed started halting and or cutting rates. What did TMF do? TMF went up as the Fed funds rate was coming down. And then the Fed basically started saying that they pretty much started signaling, where is it? Right here in November 2021, right at the top of this move on TMF, they signaled that they were going to start raising rates. And what did TMF do? It started going down. Now, the thing I want to point out here is that, in my opinion, I do think the Fed's going to cut in September. So this could theoretically start moonshotting as soon as September. Again, you guys can see here back before the Fed's or during the Fed raising rates back here, we had kind of this shoulder, this low, and then like another pullback, kind of like almost an inverse head and shoulders pattern, which is a bullish pattern. And then we rip to the upside, right? And this right shoulder here was happening right as the Fed was getting ready to cut rates, and then it took off and the Fed cut rates. And of course, we got this big move. So TMF, again, we're seeing something very similar here. So the Fed was already in the process of raising their rates. We got the left shoulder and the bottom theoretically here, and then we have the right shoulder. Again, just like before, right about the time that the Fed's going to cut rates. So if history is to repeat, this thing will go up massively. It's hard to say exactly how much it will go up. I mean, this thing's pretty much almost at all-time lows. It is at all-time lows, as you guys can see. So the last time from the bottom to the peak here, it went up 276%. If it just goes up 276% from where it currently is, we'll just say it's going to be about $230. So you're still taking a look at potentially as much as a 4x here. So once again, I'll just simply say, if one way you could do this instead of just simply buying TMF on the possibility of the Fed cutting rates, which basically this would be like it would be like a inverse play. So short ETFs, we'll get into that in a minute, but it would be essentially like a short ETF, except again, bond prices will go up in value as yields come down, which happens when the Fed cuts rates. Okay. So TMF is basically a bond fund. Again, yields will come down on bonds, prices will go up, so TMF will go up as the Fed is cutting rates. But you could stack on top of this and say, well, okay, not only do I want to make money from the price of TMF going up, but I also want to buy dividend paying stocks on the dip. So you could do that. You could buy your favorite dividend paying stocks or dividend paying ETFs or whatever they are. Okay, whether it's Realty Income or the Yield Max ETFs or FEPI or SPYI or anything under the sun that pays dividends as they go down, because again, these dividend paying stocks need ETFs. As the price drops, generally speaking, they pay more in dividends. When it comes to options, when there's more volatility, whether the price drops or not, or whether I should say it drops or goes up, more volatility equals what? More options premium, which means these options based ETFs that pay dividends are going to pay more money. So something to consider, you could buy the options-based ETFs and dividend-paying stocks and ETFs while simultaneously positioning yourself to go long in TMF or TLT as the Fed is cutting rates. So now I want to go over TLT, and I'm actually not going to use TLT as an example here. I'm going to use TLTW, and I'll show you guys why in a minute. So very similar thing here. TLT does actually have a lot more history here. So you can see it goes all the way back to basically around the dot-com bust. So if you guys can see here, so it looked as if TLT right here bottomed out right about the time that the Fed halted rates. Okay. And what did it do? As the Fed was cutting rates, the price of TLT continued to go up. And as the Fed funds rate was low, the price continued to go up until, again, the Fed started raising rates. What did TLT do? It went down. And then as they stopped and cut rates, it went back up. And I think you get the point here, okay? So personally, we're going to start buying TMF this week on Monday. I don't know what the exact dollar amount is going to be, but you guys will see in our weekly videos. So another thing that you could do is you could do the SQQQQ or SPXU. There's also a massive list here. You guys can look this up for yourself. There's all kinds of short ETFs out there on the market that if you think the market is going to go down, you could get into short ETFs with the intention of the price of the short ETF going up in value to hedge against a market downturn. I will caution some risk here. Again, not financial advice, but if you're going to short the market, do understand that there is greater risk to being short than there is to being long. Generally speaking, history favors the bulls. And you have to understand from a trading and investing perspective, if you're going to short, please consider having basically please consider not just understand that at some point in time that if there is a downtrend, it will eventually end and the prices will go up and the SPX and all that will eventually go to new all-time highs. And if you hold these short positions for long term, you're probably going to get wrecked. Okay. There's a reason why we don't short anything besides futures. Okay. And that's because we day trade it. But in terms of like investing and swing trading, we just simply do not short. Okay. Because when you're long a position, it can only go down to zero, which means you lose 100% of your initial capital. And that sucks. But when you're short, the loss risk is infinite. Okay. You can lose more than 100% of your money. You could lose as much money as the thing continues to go up. Okay. But I do want to point this out. I want to give you guys this as an option. So basically, what I'm suggesting here is the first strategy would be something like TMF TLT, which is basically inverse a market downturn, and or short ETFs. Personally, we're gonna go with what is it called? TLT. Or not TLT, TMF, and we do also have TLTW. The reason why we're doing TLTW instead of TLT is because again TLTW does pay a monthly dividend paying stock. So basically, you get monthly dividends, and if the Fed cuts rates, which I believe they're going to, the value of TLTW should theoretically go up like TLT, but you're also getting paid a monthly dividend. So that's strategy number one. Strategy number two would be basically dip buying dividend paying stocks. So some of the lower yielding dividend paying stocks that I'll point out to you guys that we have or have had in our portfolios that maintain their value over time would be things like basically RIV or let's see, pretty much things like RIV, QYLD, RYLD, although I don't think these are necessarily all that great, but something like SVOL, RIV, OPPRA. Let's see what else here. We got Main Street, NUSI, JEPI, PDI, Horizon, EFC. These have all maintained their value relatively good in comparison to a lot of stocks. I know it doesn't seem like it based on the chart because, you guys might be looking at this and saying, oh, well, at the peak of the bull run, it was up to $19. Well, I mean, you guys got to understand some individual dividend growth stocks like Walgreens or Leggett and Platt or some other stocks have just gotten absolutely smashed. Moderna just recently went down like 20%. So in my opinion, I think these are probably a little bit more stable. A lot of these are also diversified. Okay. And you guys got to understand when the Fed cuts rates and they go back to quantitative easing, all of these are eventually going to go back to highs anyways. You can see the pandemic price down here. And then what did it do? It went all the way back up to $18. So you got a $10 increase on this position. And again, a lot of these are monthly dividend paying stocks or ETFs. But what you could basically do is you could look at the charts here and you could map it out and say, and we're not going to go over this personally. If you have TradingView, this is something that you can do. But pretty much you can kind of just like map out an area that you want to look at and you want to say, okay, let's say RIV gets into this box right here. I only want to buy RIV when it gets in this box. So basically 980 to 1170. Every time it gets in there, you could buy it and then, wait for it to rip and then just simply build up like a cash position. And then kind of bulk buy as it gets into this box or whatever box you prefer, whatever kind of zone you're looking at. And just simply not buy it if it's not within that zone, and then buy it heavily if it's in that zone. That's basically known as buying the dip. A lot of people also use this as position trading. What do I mean by position trading? Well, basically, it's the same thing we showed you guys on Bitcoin on the 4-hourly time frame, if you remember that. Basically, you do nothing. Just simply sit on cash, build your cash position. If it gets in this box, buy massive amounts. Again, don't invest more than you can afford to lose. Not financial advice, just smart common sense. So you'd be buying down here and then selling the entire bag up here and then rinse and repeat if that's something you wanted to do. A lot of people did that during the 2022 bear market. Suckers rallies, you can see it'd be a nice 35% gain on top of a monthly dividend. I mean, there's a lot of examples here, so you guys can see that ACP is also massively down. This is one that we get paid about $20 a month for. The recent peak that it had was all the way up at $12.50. So you're talking roughly about a 2x from the current prices. You could do pretty much essentially the same thing here and just kind of look at this and say, okay, well, I think like maybe not even that low. Maybe you could do something like this, maybe have like a broader range. And just simply say, okay, if ACP gets into this box between 550 to 640, I'm going to buy here. And then I'm not going to sell. I'm just simply going to buy in that box. And then I'm going to sell in this box. Or if you don't want to sell, you don't have to. But of course, there is a risk it could go down further in a bear market. So you could just simply say, I'm going to buy in this box and I'm not going to sell until it gets to this box, or I'm not going to sell at all, but I'm not going to buy unless it gets in here. So anywhere in here, I'm not going to buy. I'm not going to sell up here. I'm only going to buy down here. Anywhere in here, I'm not going to buy, or I'll buy in here and sell up here. But anywhere in here, I'm just simply going to sit on cash or cash equivalents. So, I mean, you could be looking at as much as a 60% move on this one. If I were to take something else, like maybe let's say SPYI, for example, which I know is a popular one for a lot of people lately. So you could take a look at something like this. And again, this is why it's a good reason for, and again, I can't tell you guys what to do, but it's good to learn technical analysis. So, stuff like this. You could take something like SPYI and say, okay, well, these are kind of the zones I'm looking at here. So pretty much what I'm thinking is like, okay, I can see the zones here. I want to buy anywhere from 48 to 48.30. And then if SPYI gets up to 50.51 to 51.30, I'll sell up here. I'm not going to do anything in this zone, this blank space in between. I'll either buy here and hold, or buy here and then sell up here. And then the entire time you can collect dividends in between. So again, on this move, it's 7%. 7% is not much, but when you add that on top of the dividend, it turns out to be quite a lot. So you can see it's pretty rare for this thing to actually get dips. And when it does happen, it takes a while to actually play out. So, and of course, you can go back in time and history and look at lower levels and be like, okay, this is another lower level. So, if it gets down here, I could buy some. And then if it gets through this level, I just simply won't touch it until it gets down here, and then, rinse and repeat. So that's strategy number 2. Now, strategy number 3. So strategy number 3 that we're going to go over is kind of a mix of things. So this would be a combination of covered calls and buying puts. Again, I'm not an expert on buying puts, so do your own research on this. Buying calls, buying puts, it's not something we've actually done here, but it can pay a lot if you are right about directional bet. Again, that probably requires a little bit of TA, understanding of the markets and stuff like that. It's for more complicated and sophisticated traders and investors, not just people looking to buy dividend paying stocks. So covered calls / buying puts. Now there's a reason for this. I'm going to show you guys why. So let's take something, for example, like I'm trying to think of a good one. So we'll go with PLTR. Okay. And you don't necessarily have to buy puts. So basically, when you buy a put, you're expecting the price of the underlying stock to go down in value. Okay, that's what happens when you buy a put. When you buy a call, you're expecting it to go up in value. So basically, buying a call is a bullish bet. Buying a put is a bearish bet, whereas the inverse is true with the selling the calls and the puts. Okay, selling a call is a bearish bet, and selling a put is a bullish bet. So we'll just get that out of the way now, so you guys understand that. So something like Palantir, for example. So there's a reason why I suggest, I'm not suggesting, but just a strategy you guys can use if you want to. So either doing a combination of covered calls and buying puts, or doing a combination of covered calls and cash secured puts, which again, if you're going to do covered calls and cash secured puts on the exact same stock, you're betting in both directions on the same stock. You're getting paid on both directions, but you also need more capital to do so too. So, all right. So let's just say, for example, you want to go, let's just say 6 days out. Okay. And you got your shares, let's say a market price, 24.65 or somewhere thereabouts. And you want to do, we'll just go with something like maybe this one, $27 strike price, $80 in premium. That's for one contract. Okay. So basically, you're getting paid the premium you want. In this case, if you want the shares to get called away, they would get called away at a $2.50 profit. So assuming they get called away, you'd get $250 in profit, plus you'd get the $80 in premium. So now we're going to go to buying a put. Okay. Again, this is a bearish bet. So if you were to do, let's say, an at the money put, okay, so $24.50, it would cost you to buy this. You would have to pay money. Again, if you're selling calls and puts, you're getting paid. If you're buying calls and puts, you have to pay money. But it would cost you $159 at market price to it would cost you basically $159 to be able to buy the put, again, for the same time frame. So you're basically doing a double hedge here. You're getting paid premiums to sell calls, assuming the price is going to go up, shares are going to get called away, and you're buying a put thinking like, okay, I'll just hedge my bet here and say that the price is actually going to go down. And in this case, it would cost you $160 to buy the put, and you would get paid $80 in premiums to sell the call, and that is regardless of whether the shares get called away at a profit or not. So it would only cost you $80 essentially to do this. Again, do your own research on understanding what it means to buy puts and calls. I'm no expert on this. I'm just throwing this out there as a possibility for a hedge. Now, if you really didn't want to pay any money, in terms of premiums, you could go roughly about a month out. Okay. And you could do something like an at the money call here. Let's say, once again, you bought at roughly the market price and you say, okay, I'm going to buy 100 shares in the market price. I don't want to pay anything to put on the put, or I want to pay next to nothing to put on the put. You could buy one of these, which will pay you roughly about $125 to $160. Again, $160 is about what it costs to buy the put. So you'll get paid premium on the one end, and then you're essentially giving back the premium on the other end to do a shorter term bearish bet on the market, which if the put goes down, you'll make money. If the price of the stock goes up, you'll lose value on the put, but you still get paid money from the premiums from selling the calls. So this is one option. Another option, of course, is buying both puts and calls. If you are not buying puts and calls, selling puts and calls. So we like to do this on a weekly basis. Again, we could do something like roughly about a 30 delta in either direction. Again, you need more capital for this. So roughly about a 30 here, $66 a week. It would cost, so basically we would have to have the 100 shares already, which at market price currently would be roughly about $2,400 or so. And then to sell a put, of course, it costs less money up front, but you would still also get paid premium. But again, you have to have basically double the capital to be able to do this. So in this case, 30 delta, you get paid $91 in premium on the put side. Do understand that if you get exercised on a sell put, you are required to buy the shares. Whereas on a sell call, if you get exercised on the sell call, you are required to sell your shares. But again, this is if you have the money and you want to hedge both directions and you also want to make double the money, this is a good way to do it. Just understand that the stock, unless the stock does nothing, the stock is going to go one way or another. I guess technically if the stock did nothing, if it just went sideways, it didn't go up or down, in that situation, you already have 100 shares for the covered call and you have no shares for the cash secured put. You did not get assigned on either situation. Okay. Which means you did not have to sell your shares and you did not have to buy an additional 100 shares. And you got paid the premium for both. So you technically made $150 a week, or in that particular week, basically for the stock doing nothing. So it's a win-win. You got paid and you did not have to depart with your shares, and your shares did not go down in value. So anyways, this is 3 powerful strategies you guys can use to hedge yourself in a market downturn. Again, the options one can be applied to literally any stock. It does not matter what the stock is, as so long as the options is available for it. TMF and TLTW is a little bit, it's basically the non-short short, in my opinion, that you can get paid passive income on. When the Fed cuts rates, the price of those should go up in value. You also make passive income. I do believe TMF pays dividends. I think it's just quarterly. TLTW is the one that pays monthly. And then there's the option of the short ETFs, and then of course cash buying dividend paying ETFs on dips. When you buy the dividend paying ETFs or stocks on dips, you guys got to remember the stock and the yield have an inverse correlation. So when the share price goes down, you get more income for less money. Okay, when the share price goes up, you get less income for more money. So just understand that. Anyways, hope you all enjoyed this content. Please like, comment, and subscribe, and I'll see y'all later. Peace.